Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I want to go over the simple math behind analyzing a rental property, since a lot of people may not know where to even start when it comes to running the numbers. Thankfully, it's really not that hard once you learn the basics. So I'm going to go through an example today using good old-fashioned pen and paper to show you how easy it is to actually run the numbers on a property. If you find this video helpful, be sure to leave it a like, since that would help the channel out a lot, and it would help to show this video to other people who might be looking for how to actually run the numbers on real estate. Without further ado, let's go and run the numbers through an example property. Alright, so here's my pen and here's the paper, and let's go ahead and do a quick deal breakdown. So this will be more of like I'll call it a Midwest deal, since you may be surprised to learn that you can get homes for about $100,000 or less in the Midwest and some other areas throughout the country. I know that might not be the case where you're from if you happen to be in San Francisco or maybe East Coast. Basically along the coast, things can get a lot more expensive. But these deals do exist. If you want to see a deal that I got for under $100,000 in Indianapolis, Indiana, I did a full breakdown. I'll go ahead and link that above right now. So let's say the purchase price is $90,000. For reference, the purchase price on the property I bought in Indianapolis was actually $85,000. And it was totally livable. It's not as though it's like a gut rehab or anything like that. Oopsie, I meant to say $90,000. So then we'll say closing costs are $5,000. Could be more, could be less, but just trying to keep the numbers nice and easy to follow. And then you'll have reserves as well going into this of $5,000. Now your reserves are money that you set aside to make sure that you have money ready to go in the event that you don't have rent coming in or you have to make emergency repairs. You always want to have money set off to the side, especially when you have a loan on the property, because you never know what's going to happen. When you start out with reserves, then you'll always have money ready to go. You won't have to save up anymore to already have a reserve fund ready to go. Not that you shouldn't contribute to it every month, but you should always come into a deal with some reserves at the least. So if you add all this together, you have $100,000 to actually make the acquisition. But of course, you're probably going to be using a mortgage, so we'll go ahead and subtract that off. We'll say you get $70,000 at 4.5% interest, which is actually kind of high depending on the kind of loan you use. It might be closer to 5.5% if you use like an LLC loan, or it could be much closer to about 3% right now because of how low rates are. So we'll just say 4.5%. If you're watching this in the distant future, maybe rates have gone way up. I don't know. So that means that your initial investment is $30,000 because it's the $100,000 up here minus the $70,000 in the loan you got. So you have initial investment of $30,000, and we'll go ahead and circle that because we will need that later. Now let's do income and expenses. So we'll go ahead and make a T chart right here. Income, expenses. Income's pretty easy. It's just whatever your rent is. In this case, we'll say your rent is $1,000 per month. And you might say, whoa, that's a really high yield. Yeah, that's a decent yield, but really not all that uncommon in the Midwest and other pretty high yield markets where the rent yield will actually be fairly appropriate given the purchase price of the property. So in this case, it's beating the 1% rule as it's called. The 1% rule would say that you'd want to aim for a property that could get about 1% of the property value in rent each month. In this case, you have a $90,000 property, so you'd want it to have about $900 per rent at the minimum. Generally, this is a very broad rule. It doesn't work in every case, but that's kind of what it's going for. So it's a pretty high yield property, but again, not unrealistic at all. And if you get a really good purchase price, it could be an even higher yield, but I'm just using this as an example again to keep the numbers nice and round, so we'll go from there. Now your first big expense will be vacancy. Vacancy refers to the amount of money that you're going to set aside to cover yourself in the event that the property goes vacant and you don't have rent coming in for some reason. And this will happen generally because leases don't last forever. And even if you have a tenant who's there for years, eventually you're going to have a month somewhere down the line where you're not going to have rent coming in. You're going to have to repair the unit or something like that. So you want to have money set to the side no matter what each month for vacancy expenses. This number can range, but typically it's somewhere between 5 to even 15 or 20% of the rent roll, depending on your market, depending on the property, and depending on all sorts of things. 10% of the rent roll per month going to this vacancy expense reserve fund, probably is a little conservative, but again, it totally depends on your market. A lot of people use 7% or 8% vacancy, but to keep the numbers nice and round, we'll stick with 10%, and plus it's pretty conservative. So that's $100 per month out of your $1,000 rent roll. Now, capital expenditures. This is another very important expense that you need to do each month, and it's often called CapEx. So we'll say this is 5% per month, so that's $50 per month out of the rent roll going towards capital expenditures. This refers to saving up for a roof, water heater, siding, all the stuff that's eventually going to wear down, you're eventually going to have to replace. You're saving for it now, every single month. Rather than having to scramble to find the money, you are slowly saving capital expenditures each month. This number could be higher if your property is older, maybe needs a lot of maintenance down the line that you foresee, or it might be less even if you have a brand new property that doesn't really need anything, has brand new plumbing, electrical, brand new, whatever. It kind of depends on the age of the property and when it was last rehabbed, but that's generally what CapEx is. Now, third big expense, property management. And this is important even if you aren't actually managing it, even if you are managing it yourself. Because if you ever want to move, you're going to have to turn it over to a manager. If you don't want to manage it at some point, oops, I meant to say property manager. If you ever want to move at some point, then you are going to need a property manager. So if you don't factor this into your numbers when you first buy the property, you could have a problem later down the line, and no one wants that. So in this case, I have 10%, which is $100 per month towards property manager. That might be a little high for your markets. A lot of markets are around 7 or 8% per month. Some are a little bit over 10%. Totally depends on the property, depends on the market, but we'll say 10% as a ballpark. Next, you'll have insurance, which we'll say your premium each year is $600, which is probably a little bit high for this property, but you'll be plenty insured. So that's $50 a month. And then you'll have taxes as well, which again can vary big time from market to market, but we'll say it's $150 per month. Taxes can really vary. In my home state, in Illinois, in Chicago specifically, property taxes are so high, and they're high in lots of big cities as well. So you never know what taxes are going to be just by looking at a property. You got to know the area, you got to know the municipality, but we'll just say on average, usually a property of about $100,000 in value like this one will have taxes probably somewhere between $1,000 to $2,000 per year, which over the whole year, we'll just say it's around $150 per month. But again, it can vary a lot. It can change each year. So just be prepared in the event that you're in a market with super high taxes or you're looking in one with high taxes. It could really sway the numbers big time. So let's go ahead and total this up. So that means our total income is $1,000, just the rent. You might have had additional parking rent or laundry rent, depending on the property, but since it's just a single family home, you're probably only bringing in this rental income. And then total expenses would be, let's see, 100, 150, 250, 300, 450 in total expenses per month. Now we can determine our NOI, our net operating income. This is a very important metric for real estate investors. You want to know how much you're taking in after expenses. Now, this is before your loan, so we'll get to that in a second. So I have not forgotten about that. But so that's $1,000 minus $450, which is $550 as your NOI, which times 12 months equals a $6,600 NOI. So your annual net operating income, if you didn't have a loan on this property, you'd be bringing in $6,600 per year. Again, that's with no loan. So this is how you actually determine your cap rate, your capitalization rate, as it's often called, your cap rate. So that's where you take this NOI number divided by your purchase price, which in this case is a 7% cap rate. So what this number tells you, your cap rate, it basically says if you did not have a loan on this property, based on all of these numbers, you're going to be making a 7% return. So it's your unleveraged return in essence. So it's useful for kind of seeing how expensive is a property compared to others. If you have a super high cap rate, probably means you're getting a pretty decent price on the deal. But then again, it could also mean it's a very risky deal at that. So totally depends on what the property actually is. But it's kind of a quick ballpark metric for figuring out how expensive or cheap a deal is. Typically in a nicer area, your cap rate will be lower, and in a more quote-unquote rundown or maybe crime-ridden area, it will have a much higher cap rate since there's much cheaper prices, even though the rents can be pretty high in those areas. It generally follows the risk-reward paradigm. So now let's go ahead and figure out what our cash flow is. This is the number that most real estate investors care the most about, since that's your freedom number, basically. You cap rate's all well and good, but you're probably using a loan. So what are you actually taking home when it comes to your loan? So you have your $550 NOI minus, at a 4.5% interest rate on a $70,000 mortgage, it's about a $350 payment. I'm rounding it, so don't quote me there, but it'll depend on your rate and all that stuff. So your mortgage, which means that you're making $550 minus $350, $200 per month in cash flow. That's nice. So what's that annualized times 12? That's a $2,400 annual. You guys know what that is. Annual cash flow. So that's $2,400 per month per year, or $2,400 per year in annual cash flow. So what's your cash on cash return then? This is kind of that number in a more percentage term rather than just pure cash. Because $200, if it's a huge investment, who really cares? That's not a very good use of your money. Your cash on cash return kind of tells you how much of your money you're making back in that year. So your cash on cash return would be your annual cash flow, $2,400, divided by your total investment up here of $30,000. So $2,400 minus $30,000 equals an 8% cash on cash. So not a great cash on cash return, but I mean 8%, that beats the 7% in the stock market. And this is cash, by the way. This does not include principal pay down. I'm not going to try and calculate that since you need an amortization schedule to figure out how much principal you're taking each month. And this also doesn't factor in tax benefits, which you might get with a rental property. That's a little more advanced, but this is kind of your quick math that you can do on a property. So this property, $90,000 purchase price, you're putting in $30,000 up front, and you're taking home an 8% return. It's not a fantastic deal, but it's respectable if you're trying to park cash somewhere. Totally depends on what your strategy is. And again, you'll get that principal pay down as well, which is not factored in here. That would increase your return on investment for sure. Not your cash on cash return, but your return on investment, which is a separate metric. So that's your basic pen and paper math on a rental property. You now know this property at least is profitable. It could be a decent investment. Maybe you want to knock that price down a little bit to try and increase your return. So you kind of have a great idea of what this property can do for you before you head into the deal. So as you can see, it's really not that hard to actually run the numbers on a piece of real estate so that you can be better equipped going into a deal and knowing what numbers work and what you can actually pay for this property so that it actually works for your numbers. And you don't have to use pen and paper to run the numbers. I never use that. Instead, I use an Excel sheet that I created to run the numbers on rental property really quickly, and it gives me very in-depth metrics, and I can customize it as I see fit. And I've actually included a link in the description for you guys to use that spreadsheet if you want to use it yourself. Then all you have to do is plug and play, and you plug in the price, plug in the rent, any expenses, any rehab, and it'll spit out the numbers for you really quickly rather than having to actually go through and painstakingly write it all out. Again, that's in the link in the description, or you can go to jackduffley.com and check out the free stuff tab, and you can find it there too. But if you're in a pinch and you have the back of a napkin and you want to run the quick numbers, now you know how. Anyways, that's all I've got for today. If you like this video, please like it since it helps the channel out a lot. If you like this sort of content about real estate, investing, the markets, and pretty much everything else as it has to do with personal finance, definitely subscribe so you don't miss any new updates since I put out new videos every single week. And definitely check out the One Property Retirement, the new book I just released about a simple strategy for building your retirement nest egg using real estate. It's great for beginners who might be unfamiliar with the process since it takes you from the very beginning, running the numbers and looking for property, to the actual closing process and even the maintaining the property after closing and renting it out and all that good stuff. I definitely hope you check it out, and if you do end up getting a copy of the book and reading it, definitely leave a review on Amazon since those always help. But until next time, take care.